Hello, everybody. Welcome to this CNBC live stream on YouTube, LinkedIn, and Twitter. Just after noon here on the East Coast, about 12:02. We're just getting started right now. Thank you so much for tuning in. I want to welcome to this Equity and Opportunity Exec Connect live stream, again, on LinkedIn, YouTube, as well as on Twitter right now. So Exec Connect is where we talk to diverse leaders, including CEOs, board members, founders, portfolio managers, and much more. And today, we're joined by two people that check several of those boxes. They include Jason Snipe, the founder and chief investment officer of Odyssey Capital Management Advisors, and Tiffany McGhee, founder and chief investment officer of Pivotal Advisors. Both are CNBC contributors who you see on our air all the time. Great to have you both here to talk the market in 2023, stocks, and your under the radar investment ideals for retail investors. Hello, Jason and Tiffany.
Great to be with you, Frank.
Hi, Frank.
All right, great to have you guys on here. Again, you guys are both founders and chief investment officers. Really want to lean on your knowledge when it comes to the markets for 2023. So, of course, we're coming off a very difficult year for retail investors and investors overall in 2022. And especially for those retail investors that entered the market during a big upswing during the pandemic, this may be the first downturn that they're actually seeing. So can you share with us your S&P target for the end of 2023 and what you see as the theme or the driver for this market action? And Tiffany, if you don't mind starting.
Sure. So, that's I actually got my crystal ball out for this, for this very moment right here, Frank. So really, listen, it depends on who you ask, right? So, consensus seems to be between 3,900 and 4,200 is where the S&P may or may not, is likely to end by the end of the year. But, when I think about those investors that you're talking about that kind of entered, those newer investors, we've got over 10 million newer retail investors that entered into the market in 2020 in the middle of this pandemic, because people were sitting at home and watching CNBC and getting really excited. But when I think about them and where they entered the market in this really unusual time, and where, everything seemed to be kind of like flying high and every good idea was really like ripping. And then even into 2021, where those double-digit returns continued, and then all of a sudden a switch flipped, and 2022 came, and the entire world changed, right? And so, if I'm one of those investors that got into the market in 2020, I'm not happy right now. And so, I think that thinking about where the S&P might be at the end of the year is important, but I think that what I really try to do is focus on the direction and the movement, or rather like the volatility of equities. And so when I think about this, right, think about what 4,200 means, right? So if the S&P hits 4,200, that's really about like somewhere around like a 2.6% increase. And so when you think about the fact that last year we were down over like almost 20%, that's not really helping, right? And so those investors probably, if I had entered the market in 2020, want to know, okay, well, what does this S&P have to do for me to recoup my money? And the answer is much more than 4,200. But the good news is, going into 2023, first, I believe that we're going to have some choppiness still, at least for the first quarter. But that pivotal moment that has the potential to kind of reverse the market is really the Fed, right? And so like the Fed, number one, stopping to raise rates, right? Stop rate hiking. But number two, scaling them back, cutting them, I think is very important. And so we don't really see that happening until the last half of the year. So we think like that our best opportunity for positive returns is really in that second half of the year.
All right, so Tiffany, your price target for the S&P, 4,200 for the end of the year. Right now, the S&P trading at about 3,940, but you're forecasting a lot of choppiness as we make our way there. Again, about a 2.5% rise following a 20% drop in 2022. So Jason, I want to turn it over to you again. For everybody just joining us right now, this is the Equity and Opportunity Exec Connect live stream on YouTube, on Twitter, and also on LinkedIn, and wherever one you're watching us. Thank you for tuning in. We're talking to diverse leaders, including CEOs, board members, portfolio managers, founders, and we have two of them right now, Jason Snipe of Odyssey Capital and Tiffany McGhee of Pivotal Advisors. And now Jason's going to share his S&P target for the end of the year.
Yeah, so of course, Frank, it's great to be here. And I think Tiff just recently laid out some really great points that I think are important to highlight. And one I will piggyback on is the era of free money is over. So as a lot of new investors, as Tiffany just shared, came into the market through the pandemic, it's a very different market, obviously. The Fed funds rate was essentially zero, and there was a lot of stocks that climbed and went much higher. Non-profitable, profitable, everything was in the basket. And obviously there's been a regime shift, and the Fed is moving towards restrictive policy, which is a very different climate than we all experienced in 2020. So I think this year will obviously be a lot more challenging, given the macro backdrop. The Fed has got a dual mandate. One is inflation, and the other part of it is the labor market. And we get CPI print tomorrow, which likely will have a 6 handle. We're seeing some deceleration in wage inflation, which is a positive. And obviously, to start the beginning of this year, risk on has been the narrative. A lot of names and stocks that did not do well, didn't fare well, particularly in areas of tech that are doing well this year. So my target is 4150. I believe it, from a moderate growth this year. There's still a lot of uncertainty. There's a lag effect on the labor front. Let's see where the Fed goes in this kind of higher for longer narrative. How long do they stay restrictive? What parts of the market start to fall apart? So I think, what I will say is I do believe they're more flexible than they allude to in the commentary and the pressers that we've seen. We've heard from Kashikari last week. We heard from Esther George, all talking hawkish commentary, which I think is important for the marketplace, and just letting them know that, hey, credibility still is on the line here. We don't want to experience what we experienced in the late 70s. So they have to talk a tough talk, but I believe they're more flexible than they are alluding to. So we'll see. I think there's still a lot of uncertainties there, but I believe there'll be some moderate growth here. And our target, like I said, is 4150 here.
So a bit of a consensus here between the two of you. Again, Tiffany, you're at a 4,200 price target for the S&P. Jason, you're at a 4,150. Both of you saying a very low single-digit rise for the year. And the Fed is the biggest driver. So I have to ask both of you, where do you see the likelihood? You don't have to put a percentage on it necessarily, but of a pause or a pivot or those lower rates happening in 2023. Tiffany, you alluded to it, the Fed changing direction, but do you see that actually happening in 2023?
Well, I think, at first, the first thing is I believe that we will see them stop the rate hike, right? And so consensus is saying that will happen most likely in the first quarter of 2023. And so that's a good thing. But again, that piece that we were talking about earlier is the Fed actually cutting rates. And so, it is this balance. We talk about a soft landing. It is this balance that the Fed, has to really strike between inflation, between economic growth, and between unemployment, wages. All of those things have to kind of come into play for this soft landing to take place. And so I think that there is a potential for a soft landing, but they've got to really really execute with precision. And part of that, really is understanding when to start cutting rates. And so I'm hopeful that in the second half of 2023, probably, in the fourth quarter, they might start cutting rates. I hope that they do, but only time will tell.
Jason, what about you? I mean, everybody's really focused, or they were really focused, at least at the end of 2022, on the potential of a pause or a pivot. We've gotten a lot of commentary, whether it's Raphael Bostic just yesterday or other Fed officials just saying that's not going to happen. They're going to stay on this path of higher rates for quote unquote some time. So do you expect a reversal actually in 2023?
So I don't. I do think, they'll raise again 25 to 50 basis points in February. They'll likely do another 25 basis points after that. I think 75 basis points is pretty much baked in, but they might do slightly less than that. But I don't think a pause in the sense of no more rate hikes. I think that happens in Q1, as Tiffany just shared. But in terms of cuts, I don't think that happens to 2024. They're going to remain data dependent again. I think it's really about assessing the market, the damage that's happening, whether it be in housing, wage inflation, other areas, prices of goods, which are starting to decelerate, services, which is far more sticky, owner equivalent rent. So those are areas that I think they're looking to find some headway. So, but I don't believe that in terms of a cut, that doesn't happen in 2024.
All right, let's switch gears and talk sectors a bit, especially when it comes to mega cap tech. A lot of investors gravitated towards mega cap tech during the pandemic, especially retail investors. Those stocks just seem to continue to go up, up, and up. However, when you look last year, if you use the QQQ ETF that tracks the NASDAQ 100, mega cap tech actually fell 33% in 2022 compared to a 20% fall for the broader market, far underperforming. A lot of that due to interest rate pressure and also dollar pressure. Where do you stand with mega cap tech right now? Can you share your top picks for the sector? Jason.
Yeah, so for me, to your point, Frank, the NASDAQ was down 34% last year. And, long duration assets really struggled, to your point. Interest rate pressure, served as a catalyst for that. And also the dollar, as you mentioned. But the dollar has started to come down some. It's down about 9% since its peak in late September. But for me, as it relates to kind of mega cap tech and that whole broader spectrum, I really like Microsoft. I think Microsoft's continued focus on the cloud, Azure business, the cloud business, and just in all areas continues to grow. There's a lot of innovation there. Yes, it's decelerated. It's not growing at 50% year over year anymore, but it's still growing at 30%. And I think their strategic pivot to cloud, commercial business, and enterprise, I think what allows them to continue to grow through this cycle. It's an expensive stock. It's trading at 24 times and market's roughly at about 17. It does about a little over $9 of earnings, but I think it's worth the price of admission. And there's just a lot going on there. And I think they fared well in slowdowns like we potentially are experiencing. And again, if this is a short and shallow recession, I think Microsoft could still test the time here and still do well through any type of slowdown that we experience. So I like Microsoft.
You mentioned the cloud slowdown. Actually, Microsoft getting a downgrade by UBS, I believe the day before yesterday, on beliefs that its cloud business would slow down a bit. Are you concerned about some other parts of its business as well? Like, for instance, its computer and hardware business, whether it's a Chrome notebook or a Surface Pro. Are you concerned about a slowdown in those areas as well?
For sure, Frank. I mean, obviously the PC business has really slowed, since at the beginning of last year. I mean, you see it across the board. You're seeing semi stocks really struggled last year, just the parts and, in a lot of these PCs and other things. So I do think that business will continue to slow. Again, as we look through the pandemic, we bought a lot of stuff. It was all about goods, and I think that the shift in spending has moved to services. So I don't think that business starts to move anytime soon. But I do think, as I mentioned earlier, the cloud business still continues to grow, especially on the enterprise level. Again, continuing to digitize your businesses is going to be an important theme going forward. And I think Microsoft plays well in that space.
All right, Tiffany, same question for you. How do you see mega cap tech right now, especially after the performance last year when you look at the QQQ ETF falling more deeply than the broader market? And can you share your pick?
Yeah, absolutely. So I think, we're having this conversation about mega cap tech. 2020 and 2021 is still part of the story, right? And so, I think a lot of those names that were really flying so high, a lot of that, what's baked into the valuation is what they're going to do in the future, right? And so, but then kind of transitioning into 2022, where we have a completely different environment, it's really hard to focus on the future of some of these companies when we have so many current issues. And so, I'm a big investor in tech and innovation. I mean, listen, I haven't been to the grocery store. I think I've been to the grocery store once in the past year. So I'm all about innovation. Everybody is getting everything delivered right now. And this digital adoption, we're just pushing forward. But you really do have to look, past the short term and really focus on companies who are strong right now with this kind of like high potential growth in the future. And so when I look at a company like Microsoft, it's down over 27% in the past in the past year. Could it be cheaper? Yeah, but it's still on sale. It's really, when you look at like its 52-week pricing, it's almost at its best its best pricing. And what I really like about Microsoft is they continue to kind of push innovation, and so they're talking about potentially investing about $10 billion in Chat GPT, which is owned by OpenAI. And I don't know if you guys have seen this, but I mean, I encourage everyone to go on this website, OpenAI, and kind of look at Chat GPT. I mean, we're talking about, going into an era where kids don't have to write papers anymore, where, if you want to write computer code, you can ask, AI to write code for you or to explain a code, right? Explain to me why I don't understand this code, right? It's really game-changing tech. And so, there's a lot of talk about, if Microsoft does kind of go through with this investment, they might think about, integrating AI into Outlook and Office. And so, I'm just imagining, software that, really could, respond to emails for us, right? And so maybe create a PowerPoint or write content for us. And that's what this feature is doing, is actually writing content as well. So I'm really excited about the potential of that. And so, yeah, I like Microsoft here.
Yeah, Chat GPT is something I agree with you, completely fascinating, and what it could mean for the world of not only software, but AI and things like the Internet of Things, how it might change how we order our groceries. Fascinating.
I want to do my homework for me. I'm sitting here thinking about all the things in my day that it's more like busy work. And it's like, I mean, like my mind is like, the wheels are turning. It's like, is it going to be like Alexa, where I can talk to her? Because it's going to be a her, of course, right? And it's like, what can she do for me? Is this like, does this like replace my assistant? Is she going to, schedule things for me? I'm really excited about the potential.
Yeah, fascinating. We'll have to see if that deal does go through with Microsoft. Please stay on CNBC.com for the latest developments on that, of course, as well as on CNBC itself. We're going to be following this very closely as this continues to develop. But really great call on that one, Tiffany. Chat GPT, certainly something that could be a big game changer. But remember, just last year, the metaverse was supposed to be a game changer. We've had a lot of game changers. Cryptocurrency was supposed to be a game changer. So we had a lot of game changers over the last few years. So certainly something to watch. And to both of your points about Microsoft right now, about 27% off his 52-week high. Shares are up more than 2% today, but down for the year about 2.5%. So something to watch. A lot of people believe this may be the time to buy the dip on Microsoft. All right, switching gears a little bit. While we're talking about high growth tech and mega cap tech, let's talk some of the high growth names in cloud, enterprise, and the cybersecurity space. They were all under pressure last year due to similar interest rate pressure and dollar pressure to some mega cap tech stocks. Looking at the WCLD ETF this week, trading lower than it did pre-pandemic. What's your take on this group of stocks that include Salesforce, Adobe, other cloud and enterprise names? I'm sorry, Tiffany, you first.
Oh, yeah. So, listen, what's clearly Microsoft is up there. But what's really interesting to me is this whole idea of what we've been experiencing recently, especially this year, and this increase in cyber attacks and email hacks. These hackers and these criminals are really getting smarter, right? And Jason and I were just talking the other day, and I'm getting texts supposedly from Netflix saying that, oh, we weren't able to process your payment. Click here and put in your new payment information, and it's not Netflix, right? And the same thing with cell phone bills, utility bills, and they're really getting sophisticated and smarter. And I think that in addition to cloud, especially how everybody is adopting to the cloud, we're all working from home and looking for ways to kind of function efficiently from home. All of this is really kind of been driven by the cloud. And so cybersecurity is going to be really is going to continue to be important, but I think it's going to get extra important kind of going forward. And so I like Cisco here. They're heavily invested into cybersecurity, and looking at how they've performed, they've kind of really been able to weather the storm. When you look at the past 3 months, they're up 23%, right? And so that not year to date, past 3 months. Year to date, it's a little over 2%, I believe. And then also, strong balance sheet, stable company. I look for balance sheets and business models, and we've got that here in Cisco.
Yeah, I agree with you on the rally for Cisco and other Networking and router names also rallied over the last 3 months, and companies that really support a hybrid cloud. Cisco, not only a cloud play, but also an on-prem play because they provide the networking devices and routers and things that you need to have your workloads on-prem. I'm going to toss it over to you, Jason. Do you have a pick in this high growth cloud, enterprise, and cyber group?
Yeah, so I couldn't agree with Tiff anymore, in terms of cyber attacks being an issue. That doesn't slow down in a recession or, a growing economy. That unfortunately, that theme is prevalent and remains very much a part of our lives that we need to contend with. So for me, I really like Palo Alto. It's one of the pioneers and incumbents in the space. Their software business growing 50% year over year. It's an expensive stock. It's trading at 38 times when you have a S&P at 17, but they have a long-term growth rate of about 30%. The free cash flow yield continues to grow, as Tiffany just alluded to, the balance sheet. Free cash flow yield is very important in this environment. How are we going to steer and engineer through an inflationary environment where things cost more? So I continue to like Palo Alto. It's down 25% last year. But I do think there's an opportunity even in an expensive hyper growth stock. It does have earnings, but I like it here, and I think it could still work. And I think that the cyber theme is not going anywhere anytime soon, unfortunately.
That is generally the conventional wisdom, is that cybersecurity stocks are not recession proof, but maybe a defensive way to play tech. But when you look at Palo Alto Networks over the last 3 months, we're talking about Cisco's rise. Palo Alto actually down 13%. Last earnings call, CEO Nikesh Arora said deals are taking longer to close and they had to cut some deals with some of their customers. Are you worried that even though cybersecurity generally is seen as quote unquote mission critical, that companies aren't spending on it the way that we all thought they would?
It's a great point, Frank. And obviously the price action hasn't been great over the last quarter. But what I will say, and I just read this stat the other week, 74% of companies plan on increasing their cybersecurity spend. So yes, I think some of these deals are taking longer. Their recurring revenue is still growing 50% year over year. So I do think it can continue to work. It might be volatile in the short term, with some of the volatility we're seeing in the macro environment and some of the challenge that we're all facing across the market. But I do think it could still work, as we move forward throughout this year. And I think, again, cyber is just something that we all need to deal with.
Shameless plug. I think you got that stat from our CNBC TEC survey, which you can go on CNBC.com and see that about 3/4 of tech decision makers said they were planning to spend more this year. Again, shameless plug for CNBC.com. All right, switching gears. Energy, that was the best performing sector back in 2022. This year, it's a bit of a laggard. Oil prices, of course, are a big impact on all of that. Looking at the oil prices right now, down from their high, certainly when we look back to last year, a high of about $120 a barrel. Looking right now, I want to make sure I get the most recent number for everybody watching, at about $77 a barrel right now for WTI. Jason, I'm going to come back over to you. Do you still see energy as being investable? Are you still bullish on energy? I know for parts of last year you were.
Oh, for sure. I think energy, we talk a lot about the supply-demand imbalance, which, by the way, still exists. And I think OPEC will absolutely put a price floor here in terms of supply and making sure that prices in terms of crude still remain elevated. But when I think about energy, the whole spectrum as a whole, first of all, they dealt with a world that was turned off, like the rest of the sectors have. But there was a lot of capital discipline that they had to display and work through, some financial re-engineering to get those balance sheets where they are today. So balance sheets are really strong. There's a ton of free cash flow, in most of these companies. And I also think that, there's continued prospects for growth. Like, as I said, if there's kind of a price floor as it relates to OPEC, and again, they don't all work in conjunction with where crude prices are. But when I think about the dividend history, the free cash flow yield, strong cash flows, very strong balance sheets, and a lot of these companies focus on shareholder value, buybacks, some potential M&A activity. I think these are companies that can continue to grow in this market. And if we remember, again, 2 years ago seems like 2 decades ago in this market, but for a long time we were talking about how energy was uninvestable, right? And I think that's no longer the deal as we move forward, in the investor community.
Yeah, I want to talk about your pick too. Next Era Energy Partners, ticker NEP. This is actually a company that's often seen as a renewable energy play.
So I think that's actually Tiffany's pick.
Oh, I'm sorry, Tiffany. I'm mixing it up. Let me go to your pick. Sorry.
That is
EOG. Sorry about that. That is Tiffany's pick. Jason, editorial.
That is me. Yeah. So listen, my clients are clients that care about using their powers for good. And when I mean their powers, I mean the money in their foundation and endowment, right? And so along those lines, they really want to be, in terms of like climate change, they want to be part of the solution, not a part of the problem. And they're just very clear about that. And that's really how we invest in Pivotal. You know, we do things through an ESG lens. We're really paying attention to these things. But from a money perspective, you know, renewable energy is number one, a great place to find growth, but also a great place to find dividends. And I'm going to talk about that a little bit later when we start to talk about dividends. But you know, when you look at this kind of like landscape, it's going to cost us like globally over $100 trillion over the next 30 years to kind of chase this net zero environment, right? So this kind of like this lower carbon future. And so this is a really great opportunity for investors to, you know, profit from decades of dividend growth by, you know, investing in companies that build or, you know, buy cash flow generating renewable assets. And so, you know, solar is really evolving as well. It's a key growth area. Looked at the cost of solar panels and, you know, battery storage is decreasing. But then at the same time, like the energy storage efficiency is increasing. So when I look at a company like Next Era Energy Partners, a lot of their business is like this like large scale US renewable business, right? Like wind and solar. So they do have a little bit of conventional business as well, but they're really focused on wind and solar, and not only just investing in those things, but their parent company is really also, you know, buying companies that are investing in those things as well. And so this is a long-term opportunity, right? It's an opportunity to reap growth and dividends that are locked in over a longer period of time. When I look at how NextEra is done, you know, year to date, so we're really talking about like the past 10 days, it's up 6.5%, and it fared decently last year as well.
All right, Jason, I want to go back to you really quick. Your pick, EOG Resources, just really quick. Why are you so bullish on this name?
Yeah, so EOG, I think in terms of execution, first of all, they have a really strong management team. You know, free cash flow yield above 5%. You know, they also have a dividend yield that's very strong. You know, and I think their focus again is on their shareholders. And I think when, as an investor and an owner of the stock, you want the focus to be on you. I think that, you know, from a production standpoint, you know, I don't see a lot of production this year in the basin. You know, so I do think, you know, investors will be able to benefit from, again, the capital discipline, the execution from a management perspective. And that's why I think EOG can continue to work. And again, it's worked over this two-year run in energy, but I think the separator for me is just the execution and the management, you know, with this company.
All right, EOG Resources, dividend yield of 2.5% to your point. All right, switching gears, we'll talk a little retail with you guys. We saw Lululemon out with a warning. It has had too much inventory. The stock fell double digits earlier this week after it lowered its forward guidance. Analysts have also been concerned about inventory levels across the sector. And of course, we have Bed Bath & Beyond approaching potential bankruptcy, a lot of issues there. How do you see the retail sector, especially in Q1, which is typically a slower season for retail? I'm sorry, Jason, you first.
Oh, sorry. Okay. Yeah. So retail is always interesting, to your point, Frank, in Q1. I mean, there's a lot of exhaustion from all the holiday spend, and typically it's not the best quarter, you know, in terms of ownership. But for me, you know, I like a couple of names here. I think TJX is a name that I prefer. You know, we talk about inventory and double ordering obviously has been an issue for the most of last year, and they benefit from double ordering and all the excess inventory, because they're obviously taking some of that off the table for a lot of big companies and selling it at a discounted rate, at a value rate for a lot of their customers. So, you know, TJX is not cheap. You know, it's trading a little over 26 times, so it's not a cheap stock, but you know, they're a company that benefits from the excess in inventory, and that's why I like it as There's value shoppers out here. Again, I think the consumer is still relatively strong, but obviously starting to decelerate. So as they're looking for deals and opportunities, I think TJX is a nice play in the space.
Yeah, I'm always looking for deals, man. I'm what is it, like a Maxinista? I think I'm a Maxinista.
I watch you. I know you
are. Tiffany, over to you. I know you've been a big fan of Lululemon in the past. What'd you say?
We can talk about that all day, Frank. And Frank, I am literally still in Lululemon leggings right now.
But is that still a pick for you in the sector?
Oh, always. I mean, listen, I do want to talk a little bit about some luxury brands, but Lulu is a perfect example of precision execution. I kind of, imagine these scenarios in my mind that, like, however many years ago when they first started, they were in a room and they were like, who are we going to go after? Right. And they're like Nike. Right. And they've executed on that plan to really understand and meet that the female customer, that woman where she is, and they've done it beautifully, right? Just from every little detail, and decent balance sheet. And so, listen, issues with some excess inventory didn't really feel like that this year because I definitely was part of my holiday spending. I'm going to need them to bring back that little fleece belt bag, please, if they're listening. But listen, we're going to get over this hump, and so I don't see Lulu going anywhere anytime soon, or really, really struggling anytime soon. And so I would like it at a little bit of a better price here. And so I'm willing to wait for that to happen. But long term, I still like it. And they're really branching off into the men's market. And also shoes too. They, like, in terms of like running shoes, they launched their running shoes, like their first model in the springtime, I believe, and it's sold out in a couple of hours. So I'm not worried about Lulu. It's always a good time to buy Lulu for me. But kind of getting back to this idea of luxury, and we start talking about kind of China reopening. A lot of that talk really kind of tends to be on supply chain and their part in it, right? Because it's such a huge part in it. But I really want to focus on the Chinese consumer. And when you look at the characteristics of the Chinese consumer, they tend to save a lot. But then when they do spend, they spend big, and they love luxury. And so if you listen to any earnings call of any luxury retail company, beauty company, apparel company, or even like luxury adjacent, right? So like a Capri Holdings, a Tapestry, which I'm going to talk about, they have line items, they have segments in their earnings call just to simply address the Chinese consumer. And so, as an extension of that, also travel retail. So like where are they meeting that Chinese consumer when they travel? And so I think there's a huge opportunity here when China is fully open for some of these names, like a Tapestry, who owns Coach, Kate Spade, Stuart Weitzman, like a Capri Holdings, who owns Jimmy Choo, Versace, and Michael Kors. When you look at how these names have done, even in the past few months, in anticipation of China rejoining the world and being free to move around the globe. Capri Holdings in the past, 3 months is up 47%, right? And Tapestry is up in the past 3 months, almost 36%. Right. So they're almost kind of like, defying gravity. And so, they've been able to do relatively decently in this past year, comparatively speaking. But now with China reopening, I think that they're going to get a huge bump. And then, they're going to it's going to be like, things are back to the way they were, and they'll really be able to kind of count on that Chinese consumer again.
Yeah, that Chinese reopening looking more likely than it did probably just about 2 weeks ago.
Yeah.
We saw COVID cases spiking over there in China. So it's certainly looking a lot more likely, but we have seen China have some fits and starts when it comes to reopening. I remember a lot of people were looking at the Beijing Marathon. That's going to be the date that China opens back up, and it didn't quite happen. It's taken a couple of months after that. But I think a lot of people have their fingers crossed, not only in retail, but also supply chain when it comes to chips. I mean, just almost every sector has some leverage to China. Also want to talk to you guys about dividend stocks. Dividends and free cash flow become increasingly important in this current economy that has a lot of people worried about a recession. Our Bob Pisani, the great Bob Pisani, has a great article on CNBC.com today about dividend stocks. I'm going to talk to you guys about how important is it to have dividend paying stocks in your portfolio? Have they kind of risen in rank where maybe mega cap tech was at top of mind, or energy was top of mind, or dividend stocks that have higher importance now? Jason?
Yeah, I think that's an important question to ask. And for me, as I think about kind of the dividend portion of our portfolio and how it needs to work, one of the names that we like as an example is Pioneer, which again is in the energy space. I like energy, obviously, as I alluded to earlier in the program. But when I think about Pioneer as an example, you talk about free cash flow. I mean, free cash flow above 13%, above 5 is important to us. This one is above 13%. It's a dividend. The dividend yield is also, relatively high. It's 11% dividend yield. And it's also trading at 9 times earnings. But one of the things that Tiffany and I always talk about is just the importance of the sustainability of the dividend. Like it can't just be a dividend play. Like I'm just looking at the yield and that's how I'm evaluating whether this needs to be in my portfolio or not. What's the dividend history? What's the competitive mode of the company in and of itself? And how does this operate and move in the environment that we're currently dealing with? So that's how we kind of play the dividend story. It's not like, okay, we're going to look at staples here and look at dividends and low organic growth. And a lot of the staples companies and Staples as an example is very expensive right now. That's trading at a premium to the market. But I would say free cash flow, dividend yield, the history of the dividend yield, and what place or what themes are important for this particular company and or sector that works and can continue to be profitable in the environment that we see ourselves in. So that's really our thoughts and perspective on just how we're evaluating that part of the market.
All right, your dividend picks are EOG Resources. We talked about that dividend yield about 2.5%. The other one, Pioneer Natural Resources, ticker PXD, dividend yield of 11%. So Tiffany, over to you. When you're balancing the portfolio, how important are dividend paying stocks right now? And again, free cash flow, is that one of your more important factors? I mean, I think just a year ago, it would have probably been revenue growth or EPS growth. And now it seems like more and more people are focused on that free cash flow.
Yeah, so free cash flow is extremely important, especially in an environment where it's more expensive to borrow money, right? And so, I did, Jason's homework for him, and so he definitely stole my thunder. So lunch is going to be on him. But listen, first, why I like dividends, and when we were talking the other day. We were talking about dividend stocks, and I was like, Jason, I never pick a stock or make a decision to buy a stock just based on the dividend. It's usually kind of like the other way around. And so, dividends really, we have to think about why they're important other than just simply income. And so it's kind of gives that investor an opportunity to profit without selling the stock, right? And so I like to focus on rather than the first thing, like how high the dividend is, how high the yield is. We'll get to that in a second, but really focusing on the consistent payments and pay increases, right? Of the dividends. So you look at a company, and I'm just going to throw this out there, like Coca-Cola, with like something like, 50 to 55 consistent quarters of years of increasing that dividend, right? And so what that tells me, tells me a lot about the strength of the company. So if a company has enough cash on hand to pay its investors a dividend consistently, right, for decades, and also increase that dividend consistently for decades, that tells me a lot about the strength of the company, the strength of the balance sheet, and the strength and the strategy of management. So I look at a company like, Clearway Energy, right? And so kind of getting back to this renewable energy, they're primarily focused on solar and wind. And when you think about how these companies really work, all of these renewable energy companies, they basically sell power to traditional utility companies, right? Under these long-term contracts. And so Clearway Energy focuses on extremely long-term contracts. So we're talking about decades, right? So 30, 40, 50 plus years, they have a contract for a traditional or conventional utility company to buy their renewable energy. And so that generates stable cash flow, right? Which translates into reliable dividends. And so there's just a lot that the dividend activity can tell you about the strength of a company. And so Clearway Energy, they've increased their dividend 84% since 2019. The yield currently is above 4.5%. This is a really good opportunity to, it's like a lower volatility way to make money from renewables.
Interesting. So your pick, Clearway Energy, dividend yield of 4.3%. Shares actually up 7% year to date. So some other people are kind of thinking along the ways you're thinking. So Tiffany, I want to stay with you. We're running out of time. We're going to let people get back to work because they're probably at work watching on their computer right now instead of working. We want to make sure everybody stays productive, even if you're working from home or in the office. But people love under the radar investment ideas you can't get anywhere else. So Tiffany, I'm going to start with you. What is your under the radar investment idea or something that people aren't talking about, but maybe should be talking about when it comes to their money?
Yeah, so kind of getting back to that theme of the reopening of China and really focusing on the Chinese consumer, I like a company called Trip.com. Its symbol is TCOM, and it's a travel service provider in China. They handle bookings for corporate travel and also retail travel bookings. They're up about 9.45% year to date. In the past year, right? So yesterday, a year back, they've done 62%. Right? So focused on China, but done 62%. And really 59% of that return was in the past 3 months. So that is, they're really anticipating the Chinese consumer being out and about. And so the second thing, just kind of like a broad idea, is this idea of, reviving, right? Or kind of adjusting, updating the 60-40 portfolio, right? So it is on life support right now, but thinking about moving forward, diversifying your entire portfolio with assets that are not correlated to traditional stocks and bonds. So like commodities, like REITs. And so diversification is not just throwing a whole lot of asset classes in one bucket. You really have to look at the correlation, how these additional asset classes move in relation to stocks and bonds, because you don't want your entire portfolio exposed to the same type of risk.
All right, Jason, I'm going to go over to you. You have two stock picks for under the radar investment ideas. I'm going to just lead you into one of them. PayPal shares up almost 11% year to date. So what has you so hot on this one?
Yeah, so obviously PayPal, through the leaps of the pandemic, I mean, PayPal was above 300 at one point. So, trading right around $80 a share right now. So obviously it's felt some pain, in the last year or so, and the multiple has come down dramatically. It's down to around 19 times. But what I would say about PayPal, and why I like fintech in this space, one is, they have an activist involved with Elliott Capital Management, which has a really strong, just strong backdrop in how they work with companies. And I think about their focus. Their focus is back on profitability. They announced a huge buyback last year, which I think will play well for shareholders. But they're really focused on optimizing their existing base. They were growing like a weed through the pandemic, but now their focus is on their existing base, which I think is going to pay dividends to shareholders going forward. Payment volumes were up about 9% in the last quarter. They've done some cost cutting, so they're re-engineering their financials. So I like PayPal. I think there's an opportunity. Again, the multiple has come in quite a bit, and I think there's a runway ahead. And I think Venmo as well is just a juggernaut. So PayPal is an underrated opportunity that I think could work in 2023 and beyond.
So your other one's Palo Alto Networks. We talked about cybersecurity stocks trading lower in recent months, but do you believe there's a big upswing? Do you see potentially some type of threat that comes up that increases investor interest in these stocks?
So, I think it just goes back to what we were saying earlier, just in terms of cyber attacks, just continues to be an issue. Slowdown, growth period, doesn't matter, what environment we're in. There has been some trade down in the stock. It's been experienced some volatility as of late. As I said earlier, it was down 25% last year. There was, at one point late in Q3, it was only down about 4%. So there was some acceleration in the pullback. And I think that really had to do with some of the orders and deals taking the timing, and the execution of some of these deals. So I think that has weighed in on the stock. But I think long run, again, 30% growth rate, just continues. The theme of cybersecurity continues to be an issue going forward. I still like it, and I think it could work, going forward.
All right, we're going to have to leave the conversation there. Before we go, one last word from each one of you just about retail investing going forward in 2023. Tiffany, I'm going to give you the first of the last words.
Oh gosh, that's so hard. I already talked about retail, but you know what? I'll bring up a name that Jason and I were talking about earlier. Apple. That's actually a name that I really like in terms of being kind of like consumer driven. It's really this sticky ecosystem. Thinking about how companies have kind of like executed on their business strategy. I'm sitting here using my MacBook Air, talking to you, looking at my Apple Watch for the time, and pulling up the CNBC app to check prices on my iPhone, right? And then my AirPods. So my AirPods. So it really is the sticky ecosystem. And I see, a name like that continuing to just really dominate in that space with retail, consumers.
All right, Jason, last word for you.
Yeah, I think it's going to be important this year to stay patient. I think the barbell approach is going to be an important one to stay engaged with. I continue to like energy, as I mentioned. I like healthcare. Some more cyclical areas, which we didn't talk about, is financials, like this higher for longer theme that we're all working through. So I think those areas could work, but don't abandon growth. Tech, semis obviously experienced a lot of pain. The SMH semiconductor index was down over 30% last year. So was the NASDAQ. So there will be opportunities in that space. So I think it's important to make sure you have a strong barbell as you go forward, and just be patient, because I think opportunities will present themselves.
All right, we're going to have to leave it there. Jason Snipe of Odyssey Capital, thank you. Tiffany McGhee of Pivotal Advisors, thank you. Thanks for all of you watching this Equity Opportunity Exec Connect live stream on YouTube, LinkedIn, and Twitter. We appreciate your time. Please feel free to share this on social media, and we'll see you on the next one. Thanks, everybody.